Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, February 10th at 2 p.m. in London. Markets have been fixated on the question of whether the US and Europe will enter recession this year. With Europe benefiting from a fall in energy prices and the US adding 500,000 jobs in January, it's tempting to think that recession risk is now lower, and by extension, the risk to markets has passed. But the story may be more complicated. Near term, the risk of an economic contraction or recession has fallen. Europe has seen the largest swings here, where much lower energy prices, a result of a mild winter and plentiful supply from the United States, is leading to both less inflation and better growth, the proverbial two-for-one deal. Recession risk has also fallen a bit in the US, where our economist tracking estimate for US GDP has been moving modestly higher. For markets, however, we fear that this story is getting oversimplified to a recession is bad and no recession is good. At one level, yes, avoiding a recession is definitely preferable. But markets often care most about the rate of change. It remains likely that US growth will decelerate meaningfully this year, even in a scenario where a recession is avoided. For one, the idea that the US avoids recession but still sees a meaningful slowdown in growth is the current forecast of Morgan Stanley's economists. And that's also the signal that we're getting from our market indicators. We classify an environment where leading economic data is strong but starting to soften as downturn. That phase tends to see below average returns for stocks relative to bonds over the ensuing 6 to 12 months. We entered that phase recently. Of course, the US economy has been defying predictions of a slowdown for many months now, and it could still have a few surprises up its sleeve. For now, however, we think favoring bonds over stocks is still consistent with our forecast for slowing growth, even if a recession is avoided. In Europe, we think the biggest beneficiary of lower energy prices and better growth prospects is the euro. While we think the euro performs well broadly, we think it does especially well versus the British pound, where economic challenges remain greater and our economists do forecast a recession this year. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.